Alright, what's up guys? I hope you're doing well. James here from jamesdforsythe.com. And speaking of the website, that's actually why we're here today, going over the new SOFR post. This one went through quite a few different sources. Let's see, I'll give you some kind of a sneak peek and tell you a little bit about it. So we went over a link from the Bank of Scotland, a bank holding company, the Federal Reserve Bank of New York, Intercontinental Exchange, and a few other things, just to give you some idea of what the sources were. So with that said, we'll head over to the screen share and actually go over what I wrote. Okay. And then make it bigger so you guys can see it better. All right. So if you guys can't tell, new theme and everything looks different, so it's not as the words are bigger and you can actually see the links and stuff now. But anyways, relative to SOFR, so I kind of alluded to this in LIBOR's post a few weeks ago. This is kind of the SOFR is meant to be LIBOR's alternative, and basically going to it's selected risk-free rate, so RFR. So that might be thrown around quite a bit, and basically there are two different markets, and this is where you see a major difference between SOFR and LIBOR. Is a different type of transaction. They're both for overnight funding, but SOFR stands for Secured Overnight Financing Rate, so it's secured transactions, and LIBOR was unsecured transactions. So LIBOR didn't have collateral tied along to it, whereas SOFR does. And typically, our SOFR is used as for U.S. Treasuries is what is used as collateral. And if you remember from the LIBOR post, and if you need a refresher, it's linked here. There are 5 different currencies that were a part of LIBOR: the U.S. dollar, the pound sterling, Japanese yen, the euro, and the Swiss franc. And so you can see here are the kind of alternatives for LIBOR's kind of demise, I guess, and also along with the funding market they do. So the U.S. dollar and the Swiss franc are both secured funding market, so secured repo rates, and then the rest of them are still for unsecured rates. So basically, SOFR was originally published in 2018 in April, and is administered by the Federal Reserve Bank of New York, and is one of the 3 reference rates that they use in cooperation with the Office of Financial Research. The other 2 rates include the TGCR, which is the Tri-Party General Collateral Rate, and then you have the BGCR, which is the Broad General Collateral Rate, and that's kind of based off of both it's adding a different segment of the repo market, and so it's kind of like I like to think of it as a ladder effect. So you have kind of the base one where it's TGCR, where it has that segment of the repo market, and then BGCR includes that one and GCF repo, and then for SOFR includes those 2 and the FIC cleared bilateral repo data. And we'll get into a actual picture of that later, right? And so SOFR itself is actually published at 8 a.m. Eastern, for the reflecting the previous business day. So it's actually calculated from transactions that have already happened, um, and is in arrears, right? And we'll get a little bit more into that later. Whereas if you remember for LIBOR, it was posted at, I think it was at 11 London time, which is around, it's early in the morning in the US, but I don't remember the exact time change. But yeah. Anyway, and also SOFR is now the preferred benchmark for the Alternative Reference Rate Committee, which is ARC, right? And so there's always got to be a committee, but that's a separate thing. So differences between SOFR and LIBOR. And so again, LIBOR was for unsecured funding markets, meaning there was no collateral for the specific transactions. And then there's also the fact that the primary rate for SOFR is calculated in arrears, meaning it's calculated from data that's already been collected and is looking towards the past, whereas LIBOR is more forward-looking. It's more of what rate could you pay in the future date. And I give the exact survey question in LIBOR's post too. I don't remember it off the top of my head, but it's more of a forward-looking rate, kind of pricing in counterparty risk, which I'll talk about in a little bit more in a second, right? And so again, characteristics of SOFR. So SOFR is fully transaction based, which is not what LIBOR was. In that LIBOR post, I go into the waterfall methodology and the different kind of tiers for making that the calculation for LIBOR in there. And so we do not have expert judgment is not incorporated into SOFR's calculation, whereas it is for LIBOR. And I actually re-bring up the bar graph that we had for the US LIBOR rate during their testing in the waterfall methodology, where this light blue is the level 1 submissions, which is the actual typical based off of data, and then the dark blue is derived from data, I think is the terminology they used. And so this is basically they didn't have enough actual transactions for a day before, and so they would use historical ones from further in the past and kind of weight those respectively. And then this darker blue, I guess kind of navy blue. You turn up my brightness. Sorry for the shaking, but is for level 3 transactions, which are our submissions, I guess I should say. Which this is the expert judgment that we're talking about, right? And also to keep in mind, the repo market data that SOFR gets is from the Bank of New York Mellon and the Depository Trust and Clearing Corporation, sorry, DTCC. I believe, I don't remember exactly why the Bank of New York Mellon is so important. I think they're the only clearinghouse for tri-party repo now. I think it used to be them and JP Morgan, and JP Morgan stopped doing that, but I don't remember off the top of my head. I think that's why they keep popping up is so familiar for me, right? Okay, so another thing that's important for SOFR is that it correlates very closely to other money market rates and also covers multiple repo market segments, right? And so basically, kind of an advantage of covering the different repo market segments is if you have kind of a change in incentive structure, depending within the market itself, it's more likely that where institutions will go to will still be incorporated in SOFR. Whereas for LIBOR, when we had, say, Dodd-Frank and other sorts of regulations come up, that kind of disincentivized banks from lending in unsecured overnight markets. There was a decrease in the amount of transactions, but LIBOR didn't really deal with those like SOFR does, right? And so basically, the transactions that left the market that LIBOR was calculated for went somewhere else that wasn't still incorporated in LIBOR. Whereas in SOFR, there's two other segments that could possibly be cut into that, right? And so that's why possibly coming up here, we saw a change from where we have to incorporate the different levels in the waterfall methodology because there wasn't a significant enough amount of transactions to do it based solely off of transaction data. Okay, here's a graph showing 4 overnight money market rates. We have the OBFR, SOFR, TGCR, and then USD LIBOR. Obviously, 4 different rates, and you can kind of see the 2 different correlations where you have USD LIBOR and OBFR are kind of pretty much the same. They have the same general behavior, and then separately SOFR and TGCR show the same idea. They're both kind of correlated. And so basically OBFR is the overnight bank funding rate, and it's a measure of wholesale unsecured funding from overnight bank transactions, right? And it's calculated on a volume weighted median basis, right? And basically those transactions are in the overnight Fed funds and eligible Eurodollar and domestic deposit transactions. So essentially, my biggest deal is this part here where it's the unsecured funding. So it's at least relatively the same as USD LIBOR. Not saying it's the same rate, but saying it's the same kind of general market where it's looking in that unsecured funding. And obviously, there's some differences, as you can tell from eligible Eurodollar and other transactions in there. And so maybe that's where these spikes down are coming from in the rate. And so it's obviously not going to be verbatim what the USD LIBOR is. Okay. And then the other one, the TGCR, which is the tri-party general collateral rate, which we discussed above, is kind of a subsection. So it's still incorporated in SOFR. And so you can kind of see that here, one, that it correlates so much, and two, it seems as if it's almost a kind of a minimum. Like there's no dipping below. So like SOFR doesn't dip below TGCR at any point. At least that is visible, right? I wasn't able to find like actual like say a data file or text file with all the actual numbers in there. It was basically just the graph. Right, and then if you need more on the actual repo market itself, I do have two other posts in here where this one the step-by-step one, I kind of go through, and it's literally me trying to figure out repo and being like, okay, money here, the original purchase, it goes to here, collateral goes here, and thinking through with the haircuts and discounts and everything else, right? So here we have a rolling 3-month average of the 4 rates, and you can see that the correlation is much more close. Even, or I guess I should say, especially towards as you get out on the right of the graph, right? So USD LIBOR, I guess OFR, correlate much more, and those kind of spikes that we saw in the OBFR rate aren't there as much, and then SOFR and TGCR pretty close. Just looks like a difference in shift, right? So the actual segments, the money market segments that are covered by SOFR. So we have here is the general tri-party part of the repo market, which is covered by the BNYM, the Bank of New York Mellon, and then we have the interdealer, which is the GCF repo, which is covered by the DTCC, where that data comes from. Stuff that we already stated before. It's just here's an actual picture, so you can kind of see the differences, and you can see that Fed transactions, meaning the ones that are from that are with the overnight reverse repo rate on RRP, are not included in SOFR, right? Same with these centrally cleared ones for the DTCC. And this is tri-party repo. And then you have bilateral repo, where you have non-cleared and then FIC cleared, right? And this one in SOFR includes the FICC cleared, right? And so kind of more on those segments themselves. And so general tri-party is a segment for SOFR. The data is collected from the Bank of New York Mellon, and transactions with the Fed are removed, as we saw above. So this means that transactions that are governed by RRP, like I already said, are not included. And then kind of into interdealer GCF repo, I also included an actual, this is a PDF from the New York Fed going more in depth on GCF repo because I haven't delved so far into that one specifically. But basically, GCF stands for General Collateral Finance, and it was created to reduce transaction costs and increase liquidity in the interdealer repo market. And so basically, what happens was beforehand, these repo transactions between individual dealers themselves, the primary dealers, they had to be solved, or they had to be settled on like a leg by leg, like case by case basis. Whereas now with GCF repo, they could actually net multiple legs together within specific parameters and go from there. And that's just kind of very superficially going over it. Again, if you're more interested in going more in depth, here's a link to the PDF from the New York Fed's website. So for FIC cleared, one thing to notice, I think I'm getting ahead of myself, sorry. So, no, I'm not getting ahead of myself. I just skipped it. There's an ad in the way. Sorry. So with respect to SOFR, one thing you have to deal with, because you are dealing with multiple dealers, right, is the process or the probability of double counting, accidentally counting the same transaction twice. And so because with this, you can actually see it, like the central or the counterparties are, interdealer repo, as you can tell, is a tri-party repo market, meaning there's a third kind of, I think it's the Bank of New York Mellon, but I don't remember who's the kind of main, I guess, clearinghouse. I forget if that's the exact word they use for it. Meaning that there's another entity outside that kind of basically acts as an escrow agent, I guess you could say, for the transaction itself, right? And so you have this with interdealer repo, so you know the counterparties, and it's very easy to be like, okay, it's very easy to distinguish between transactions and not double count them. However, for the FIC cleared ones, it's in a bilateral repo, meaning there's no third party. And so basically, transactions between those two entities are not removed because the counterparty's names are not available, so they don't actually keep track of that data, at least in the grand scheme of things. And so it seems like there is a possibility for double counting within that segment. On the other hand, though, I guess kind of a hedge against that or whatever, to kind of prevent that. Any transaction with rates below the 25th percentile on a volume weighted basis is removed from that data set, mostly to get rid of the impact of like specials in the calculation of SOFR, which specials are just securities in the repo market that have really high demand. They're special, at least that's how I think about them. And so that really drives down the rates and that bids up the price and typical fixed income stuff. And so it kind of can skew the rates in a specific way, right? And so the actual calculation of SOFR is not as complicated as you would think compared to LIBOR. So it's calculated by taking a volume-weighted median of repo transactions over the course of a particular business day and then published at 8 a.m. the next day, right? And so, yeah. And then there's difference in payment structures, and this is one thing that going much more in depth into SOFR, it really kind of changes. There's different payment structures in terms of how you're accruing interest over the payment period. So you can have in advance or in arrears, where in arrears is kind of the backward looking we were talking about earlier. So like in arrears, the interest accumulates like on a day by day basis. Um, so it's based and it's calculated at the end of the interest period, right? And so basically, an advantage of that is your interest that you're paying on your loan, for example, is going to be exactly the same as the interest as the market's fluctuations per se in that interest period. So that means when you pay your interest, it kind of completely hedges out interest rate risk. However, you don't know your interest payment until the end of the until you have to pay it, right? However, in advance, you know your interest before you have to pay it, so it's at the beginning of the interest period, but it's not. But you aren't you're not necessarily hedging out all interest rate risk because you're having to approximate to some degree, whether that be through some averaging or like something similar to what LIBOR did, to kind of quote unquote, I not guess, I don't think it's a good word for it, but approximate what that interest would be throughout the entire interest period. And so interest rate risk probably won't be 100% hedged out, which could be a problem. However, on the other hand, in most financial contracts that SOFR is used for, because keep in mind that's what LIBOR was used for as well, is it's the averages that are used. So that really kind of rolls out and my mind went blank. But it rolls out the kind of day-to-day fluctuations within the market. So like you see in 2019 where we talked about, and I've talked about this before, um, we had a massive spike in repo rates. And so you see this one here in the day-to-day SOFR, but when you look at the 30-day, 90-day, and 180-day averages, you can tell that it pretty much the longer term average, the less that 1 day fluctuation is actually going to have an effect on the overall rate. And that's kind of the reason why they use averages, is to kind of smooth the graph and kind of smooth the rate, meaning that there will be less volatility in the actual rates used for and referenced in financial contracts, right? So again, SOFR is supposed to be an alternative to LIBOR, so its uses are pretty much the same. For the most part. One of the things that I noticed very well was the student loans and adjustable rate mortgages, which is one reason why I kind of really wanted to. When I saw that, when I was looking into LIBOR, it really kind of piqued my interest because I was like, where? I didn't know this was what's in those ARM mortgages or some of them. And I think it was like 50. It was like 50%, or I threw a statistic in there and cited it, of course, in the LIBOR post, but I don't remember it off the top of my head about what exact kind of percentage was used in a specific time frame. But that's there. Um, but there's a lot more that goes into the actual calculation of SOFR, as I found out. And so you can actually really tweak what it could be used for, I guess, by differing the duration. So, like the averages, maybe the duration of the loan. So, the type of averaging you do, like geometric average, simple average, whatever. The payment structure, like we talked about in arrears or in advance. And there's multiple different like combinations you can do of those and other things you can do, like something that they called Lookback, observation shifts, and payment delays. And kind of, I don't want to go too far in depth and make this post and video way too long, but definitely something to look into. Here, and just to kind of give you an idea, here's a table taken from an updated user's guide to SOFR, which again is linked in the bottom, as always, giving the different products that it's used for, and then the conventions slash term sheet document that is used for that specific product, right? And so as you can tell, there's multiple different ones you could use, especially for floating rate notes, um, and go from there, right? And so as always, here's the actual links. And so like this one, the black one, um, first one, I guess I should say, the whole thing is the link. And then since this is a presentation, I kind of wanted to change the linking structure a little bit. But and I also started putting in the page numbers for you guys in case you want to kind of look at a very specific part of the post or of the source itself, and you don't want to have to scroll through because some of these sources are like 40 something pages depending on. So I figured I'd save you guys some time at least. And so you guys don't have to actually go through and read them all yourself. If you're not interested, if you are, have at it. They're always there. That's the reason I put them in the sources or in every post. And I always link whatever I take information from. So, anyways, I'm going to leave it at that. So, I hope you guys have a good night, and I'll see you on the next one.